ending 2018, I think what really was happening is that the market was expecting a Fed-led recession. So they priced that in. Everybody priced that in as investors got scared about the Fed going too far too fast. Plus, we had weakening fundamentals and market worrying about whether or not it could stand on its own 2 feet. What we're seeing for 2019 is a reasonably benign environment for the economy. So growth does slow, but it stays positive and it stays reasonably healthy. And the market is going to have to sort of come to its senses about the fact that we're not headed to Armageddon territory.
So U.S. economy continues to grow in the 2.5% range,
right,
thereabouts?
Right.
How about China, which Seema just talked about? How about Europe, where there may be other sort of internal and exogenous concerns?
It feels weird to say that the U.S. at 2 to 2.5% is going to lead the pack, but China is probably going to be 6%, maybe a little bit below 6%. And I think for China, what's happening is the incentive for them to come to the table on trade talks is increasing as we go here. And what we would expect out of China is more stimulus from a monetary perspective. We would expect them to let the currency depreciate slightly, so we're not fearing anything drastic on the currency side. And then as far as Europe goes, there's a lot of question marks out there, Brexit being the biggest one.
In the first half of the year, you say you favor financial staples as well as healthcare. Does that mean that in the second half of the year you anticipate a different weighting in terms of your sectors?
It's more that I want to check the crystal ball again about halfway through the year.
What do you see in the crystal ball for the first half?
For the first half, what we're going to see, the reason financials is on there, number one, is financials are still better capitalized than they were even pre-crisis. So the balance sheets are healthy. And if we're expecting a slowly steepening yield curve, that should eventually help financials out. Obviously, we're going to get a lot of news out of the big banks this week, so we're going to get a little bit more of a litmus test. But as the curve steepens and financials, remember, they lend on the long end and borrow on the short end, that should help their margins a little bit. As far as healthcare goes, we're expecting good things there because we still see some M&A activity coming. And M&A activity is probably going to be healthier in healthcare than other sectors.
All those things you said about the financials, though, you could have said 1 year ago, and it would have been a bad trade.
Sure.
So what makes you believe it's going to happen this time?
So what makes me believe that is when you look at what's happening in the economy and the fact that when we started this segment about thinking that the economy still has a pretty good momentum with it, the markets will come to their senses and hopefully sell a little bit of that 10-year treasury, so that longer end of the curve. In 2018, what we saw is the short end continued to come up because rates were rising and the long end didn't really go anywhere. And that put a lot of pressure on financials that was unexpected. So if everybody calms down, some of this fear comes off the table in the first half, what we should see is a little bit of selling on that longer end. The short end probably won't go anywhere because we're seeing a Fed pause coming in March and probably 1 hike, 2 max this year. So if the short end stays where it is, the long end goes up, then we finally get that margin spread.